we're going to proceed with new bank, Worthington Industries.
Can't see who's out there.
Virtu. So nice mix of companies. Could all be nice
There's three
for the portfolio as well. All right, Dr. Wall.
Absolutely. So welcome to the Spring 22 class of 23 equity reports. I believe we're the last thing standing between you and spring break, which will make this especially fascinating. Today, I am proud to present a Brazilian company, a bank, and a person named Ayden to pitch it to you. Ayden, without further ado, talk us through how you found the company and any last one question you want to clean up or that sort of thing, and take us away.
Of course. Thank you, Dr. Wall. Like you said, my name is Ayden Domico. I'm a current junior in the Applied Investment Management program here at Marquette. And today, I will be pitching New Bank or New Holdings for the international finance sector. For my screening, I originally landed on Mercado Libre. It's another fintech company in Latin America. And they do a lot of stuff similar to Amazon, but I was unable to find upside with my model. And therefore, I pivoted to New Bank. There's a Latin American digital neobank that provides bank financial solutions to customers in Latin America. 97.5% of their fiscal year 21 revenue came from Brazil. A question that I got a lot on D2L had to do with my peers and my weighting, so I'd just like to go through them really quickly. Ally Financial is a fully digital bank here in the United States. They provide many of the same encompassing financial services as New Bank does. Their closest peer in terms of their business model is New Bank, that is public. A lot of digital banks have yet to IPO. PagSeguro, another Brazilian fintech firm that has a chartered bank within its umbrella, and it provides many of the same non-banking features that New Bank does, including peer-to-peer money transfers, prepaid cards, personal loans. Yet they lack traditional savings and checking account offerings, with banking not being their focus. SoFi, as I'm sure you've heard of, it's in the AIM portfolio. Is an American personal finance fintech, helps customers to manage their finances and investments. They offer an online cash management account that functions like a hybrid savings and checking account. They also offer credit cards, investment brokering, and personal loans and lines of credit similar to New Bank, although they are not also a chartered bank. Also StoneCo, another Brazilian fintech that is also backed by Berkshire Hathaway. They offer similar financial services, but they're more focused on the business side of things. And then Itaú Unibanco is a traditional long-standing bank in Brazil that also serves as the credit card interchange service provider for many of the financial services firms in the country, including New Bank. Both banks offer traditional banking services with credit and debit cards, and the two firms are very close in terms of size by market cap. While the factors for each peer differed, I felt in the end that each of them were similar enough to New Bank in different ways to weigh them equally. And with that, I'll open it up to questions.
I'll start here. Let's make certain we understand the business model here. This is the bank that makes its money through loans and earning higher return or yield than it costs, as well as fees and other things. So when I look at the box that you have, I don't see some of the traditional banking stats that I'm used to seeing, like percentage of bad debt or uncollectible. Did you see traditional banking metrics for this firm?
Yeah, there are traditional banking metrics for this firm, but their strategy to acquire customers is quite different from most of the traditional banks in the world, and specifically in Brazil. In Brazil, there's an extremely rigorous process for just to apply to open a banking account. There'll have to be several face-to-face meetings. You'll have to procure several documents, much more than what we had to face here in the United States, where you can open an account in like a day. And on top of that, they then charge fees on accounts in the hundreds of Brazilian reals each year, which is over $20 on American US dollars. So having a bank account in Latin America is typically for middle and upper class individuals. New Bank is targeting underbanked, lower class individuals who've never really been provided the chance to have a bank account before. And so their customer growth model does not allow them to be profitable early on, but they've done a great job with equity funding. They had their IPO this past December.
Right. Let's go back to the profitability again, because at some point they have to make money, and you're showing that they eventually do. These new customers that they're acquiring, they're getting them because this is a digital bank with low or no fees.
Mhm.
Are they successful in lending money to this
Yeah.
new group of customers? And if so, are they, are they earning an adequate spread and are they able to collect and not have a high amount of bad debt?
Yeah, of course, with targeting lower class individuals, there's definitely going to be the risks of non-collectibles. In terms of their NPLs or non-performing loans, means that the customer shows no signs of being able to make payments. The management stresses that their loan underwriting algorithm is much more successful than the methods of other financial services providers within their market. They boast, on average, 1.2% lower 15 to 90-day non-performing loan rates compared to the rest of the Brazilian market, as well as 1.5% lower 90-plus days non-performing loan rates. The algorithm takes many things into account that typical underwriting processes cannot, such as a digital footprint as the biggest example. This is some metrics here. Cumulative revenues minus cost of funding as a percent of amount lent has increased 19 percentage points over the past 12 quarters to 21%, while the cumulative cost of risk as a percent of amount lent, meaning like the COGS of making loans, has only increased 3 percentage points to 10%, showing that the scaling profitability of new bank is increasing. Similarly, the cost of risk as a percent of amount lent has fallen all the way to 0.1%.
I did not set them up for that. Very good. That's what I wanted. Good.
That's how you pivot when you just got put in your place.
Well, I asked the question.
Great work, Ayden. Can you kind of touch upon their customer acquisition process and how much does that cost to acquire each customer?
Of course, yeah. New Bank's management boasts a very, very, very low cost of acquiring customers. Their number one marketing strategy is word of mouth, which they spend $0 on. Based on the account not having fees and many of the advantages that I listed over traditional bank accounts in the region, has prompted the growth of the customer base to over 45 million people in just a span of 4 years. I think in 2018, they were under 10 million customers. So their customer growth has really been at a low cost, and that's what's driving their fast scaling towards profitability.
Perfect, thank you.
Christian.
Yeah, can you kind of talk about the 0.5 beta? I'm kind of curious how that might play maybe relative to the industry, or especially how that might fit into the portfolio.
Yeah, of course. Since they IPO'd just in December, there's very short price history. That's the daily beta compared to the MSCI All World Index XUSA. But to incorporate that, I included a risk premium for the beta to account for maybe, because 0.5 beta is very unrisky. I wanted to be able to account for maybe any additional risk that they may incur as the beta will most likely increase as time goes on. So I wanted to account for that in some way while still keeping the original beta I calculated.
Okay, awesome, thank you.
So how much did you add on?
2% premium.
Okay, and then we got a question online then, Rishi. Joe Anderson's online. What is the median wage and is it growing in Brazil, I assume? Any idea?
I don't have those. I get those following.
Okay, and what is the GDP per capita and has it been improving?
The GDP per capita has been, I don't have the exact numbers with me.
Ballpark?
But,
It's okay.
No, I had no ballpark, I'm sorry, but it has remained flat over the past 3 years for the most part. It's projected to increase this year following the end of the COVID-19 pandemic, but now reports are starting to scale back estimates a little bit due to the current conflict with no resolving in sight.
Rishi?
Awesome. Do you consider using traditional bank valuation techniques like price to book? It can even justify market cap per user. Give some metrics on how much revenue per user there are.
So it could be the very end.
So what's revenue per user?
Revenue per
Can you justify the technique you use as opposed to traditional banking metrics like price to book?
Yeah, in terms of market cap per user, I'll just start off with that. Their rapid customer growth is the main goal of management. Profitability has not been the main goal of the company in its early formative years. They've raised over $3 billion in funding, which has kind of given them some comfort space in terms of building up their operations, their support team, and their customer base before focusing on making profits in the long run. In terms of revenue per user, I have some statistics here, I believe. I don't have the revenue per user on hand, but I do have some cost of serving active customers. It's decreased at a CAGR of 15% over the past 3 years. Going from $2 million per million customers in 2018 to $0.8 million in fiscal year 21. So the cost per user are decreasing, and I can't say that the cost or the revenues per user are increasing, but I'll get you those stats right after.
Yeah, no problem.
We got a question from Hannah online. Hey, Ayden, great presentation. Shot. Can you touch on Brazil's economy? For example, look at her go. Is new accounting for any currency volatility in the future, and how do they adjust such? And if you don't know that answer, I'm going to throw a piggyback. Did you account for any currency volatility in your modeling? So any of those questions.
Yeah, first, I definitely got a couple questions at D2L about the state of Brazil and stability. So I'd start off by saying that Brazil, both Research on the Street and myself, see that Brazil's regulators have promoted a competitive environment for fintechs over the past half decade or decade. And that plays to new bank's advantage as a small fintech firm, but as they continue to grow into a larger bank, that may hurt them in the long run. One example of the caps on the amount of card interchanges that can be made for large banks in Brazil. In terms of the currency fluctuation, as well as kind of tie in Brazilian inflation with that as well. While inflation has been greater relative to the U.S. and currency inflation as well, Brazil in the region, in Latin America, is much more stable for conducting business and for currency fluctuations than other countries. In terms of what the currency fluctuations do for Nubank, they are not, while they report in dollars on the New York Stock Exchange, their operations are fully concentrated in Latin America, so there's no need for them to bring that currency back to U.S. dollars. So currency fluctuations, while they are a worry for customers and whatnot, I don't think that's going to be a major issue for Nubank in the future.
Sarah.
Hi, so you mentioned credit and loan default as a risk. Just going back to that initial question, you talked about how they have 45 million customers. How many of those customers are were previously, I guess, underbanked? And because of that, did you kind of factor in more risk just because they were previously underbanked and now there's maybe more potential of a credit or loan default?
I didn't factor in any additional risk just due to management's comments on their algorithm and how well it's been working. They've shown consistently since their first results releases in 2018 that their non-performing loans and lines of credit are much lower than typical rates in the Brazilian and Latin American economies. So I didn't build that into my model. I'm sorry, could you repeat the very first part?
So I guess just how many of the 45 million were previously underbanked?
I don't have a specific number of how many of their customers were underbanked, but what I can say is, for my write-up, in last fiscal year, about 45% of Latin Americans didn't have their own bank account. 79% had not ever used credit or borrowed from any financial institution, and only about 12% of Latin Americans had at least some money deposited into any savings account.
That's why this is one of the nice ESG portions of this company that you weren't able to find out. The ability to serve the underbanked or underserved population is possible because of digitization of Nubank.
And just to touch on that, I know that I didn't give an ESG rating on my boxes for Nubank, but that's because they've been listed for such a short time that none of the major scoring companies have really given them a grade. Overall, I can get into it a little bit deeper if someone would like me to, but overall I gave them a B+, and the only major knock on them in terms of ESG has been that the two co-founders and CEOs, they hold about 40% of the voting power within the company. But I actually don't see that as a negative or a downside just because these two individuals, they drive the mission of the company. CEO, David Velazquez-Norno, he regularly cites how difficult it's been for him as a Latin American to get access to banking services. And he has been in private equity working on Wall Street. So his leadership definitely speaks volumes. And as long as those two are there, I think the company's going to be headed in the right direction.
Patty, bring us home.
Interesting you mentioned the voting car. I was just curious if you could dive more into the mechanics of the IPO, like who owns it, lockup period, any expectations of that?
sorry, what
Like
period?
what, so who owns it? You said 40% of voting power, but any other institutions that own it, like initial price and any, like, do you know when the lockup period ends or any anticipation of what's gonna happen after?
Yeah, in terms of who owns it, there's a fair amount of institutional ownership. Berkshire Hathaway has been involved since before they went public. I think they originally invested $500 million in Series C funding. And then once they went public, they invested another $500 million. So they have about $1 billion stake in the company. Other investment firms include Sequoia Capital, Sands Capital. Sequoia has been with them from the very, very beginning. They've got one or two members from Sequoia on the board of directors. I don't know when the lockout period ends for the IPO, but following the IPO, all in all, I think it's a very, very long-term play. Just seeing as they're unprofitable in 21, and I don't have them going profitable until fiscal year 23, while some on the street have it in 22. With the long-term play, I think the stock price is going to definitely fluctuate and maybe even dip in the short run. But in the long run, the service that it provides is well needed in Latin America. And as they continue to spread to more countries, they just started spreading into Colombia and Mexico, and they have plans for Uruguay and Argentina. As they continue to expand, if they expand into a larger country such as Argentina, for example, price may fall as costs to move capital and to build up systems in different countries increase. But in the long run, the value of the service added is definitely going to show, and they have a very large total addressable market.
Cool. Nice question, Manny, because this is important 6 months after an IPO. And with 24% quote insider holdings and a lot of PE firms, we have to be mindful of what kind of selling we could see in June. So that was a good question. Good response. Thanks.
Thanks.
All right, next up, we have Worthington Industries, right? What do we got, some sort of steel processing going on?
Yes.
So Jack Bender's gonna pitch, and Jack, same thing as usual, talk to us about how you found it.
Couldn't do without you.
If there's one question you wanna resolve, and then we'll move into Q&A. Thanks.
Everybody, I'm Jack Bender. I'm a junior in the AIM program here, pitching Worthington Industries. They're a big steel processor, majority serving the automotive market and construction markets. I came about this company through mostly looking through peers. I was really looking for a precious metal company, specifically steel or aluminum, that could serve the automotive market. I went through various peers such as Nucor and US Steel Corp. And I just, some of them were just too big market cap to pitch, and I also didn't really want to pitch a minor, so I landed on Worthington. One question that I got on D2L a lot was about midterm EPS growth being negative. There's a couple reasons for this. 2020 steel prices saw an all-time low, and in 2021 steel prices saw an all-time high. This had a large effect on Worthington's margins as well. Worthington also divested from certain companies in 2021, which saw some unordinary gains on their balance sheet and income statement. This was Nikola Corp specifically for $655.1 million after-tax gain. With that, I'll open questions.
A big ROE. Now, that can be distorted because of the period we just went through, right? We talked about the most recent year. What has typically been, if you know, ROA and ROE for this company long term?
Yeah, so I did a DuPont analysis for the company, and the ROE was right around 46.5% long term. And ROA long term, I haven't done ROA long term. I can get back to you on that. Yep.
Jackie, with the communist dictator Vladimir Putin, these gas prices out of control, right? So if this continues, do you think Worthington's going to switch from, going to focusing on the big three to trying to partner up with EV companies?
Yeah, so that is a big part of the story here with Worthington. They recently acquired Temple Steel Company for $255 million in 2021, specifically December 1st, 2021, so it's relatively new. They serve electrical steel, mostly. Electrical motors and transmissions is a big part of their revenues. They do around $377 million annually in revenues. So I do see them starting to branch out away from the big three a little bit with their Temple Steel acquisition, and specifically Germany could be a place where there is some revenue growth because they've obviously made a commitment to switching away from traditional vehicles into electric vehicles.
Wow.
Yes, sir.
Hey, Jack, good job. Touch on your, if you could, touch on your insider holding number. Do you see this as concerning, being that it is 38%?
Yeah, so I got a couple questions on this on T12 as well. John P. McConnell, he is the big insider owner. He owns 33.71% of the company. His father was the founder of the company in 1955, and it passed down to him afterwards. He's also a big investor in the Ohio region. He owns the Ohio NHL team as well. He is right around like mid-60s, so I would say he's nearing retirement age. He recently stepped down as CEO and moved to executive chairman of the company. I do think that with him moving down in 2020, there were a lot of acquisitions in 2021. So I think if he wanted to, disrupt that, he could have, and he did not. So I think that he and ownership have, a long-term view that fits with each other, and I think that it's not as big of a risk as you would see with like a 38% insider holdings.
Christian.
Yeah, so I'm just kind of curious with your EPS, kind of going, starting at 16 last year and then going down in like the 5 to 4 range. What's going into the price to earnings going from like 7 and then kind of increasing on average, kind of specifically there?
So can you restate your question?
Yeah, so so the earnings per share starts at 16 in 21 and then kind of goes down to like 5, 4, 5. I'm just curious because then the price to earnings is going up. So I'm just wondering what's driving that specifically.
Yes. Oh yeah. Okay. Yeah, I might have an issue with my boxes there for the 2021 number.
Okay.
Specifically. The reason there's fluctuations in EPS in the out years is projected futures prices for steel. Specifically, like 2023, there's supposed to be a dip in steel prices back to more historical numbers, as there's been a very huge increase in 2021, and then in 2022 it's supposed to stay at high levels, and then obviously 2023 is supposed to come back down a good amount.
Okay, perfect. Yeah, that's what I was looking for. Just kind of an explanation.
Rishi.
Yeah, can you maybe break down your revenue growth by organic versus acquisitions, and maybe can you break down how much that's coming from EVs specifically? Good.
Yeah, so organically, pre-acquisitions, they've run consistently around $3 billion in revenues yearly. Looking at some of their acquisitions and the revenues of those acquisitions, Temple Steel, I already said, it was $377 million, and General Tools they're a private company, so it's kind of hard to see like their full historicals. They did about $70 million in 2020. The PTEC is a very small company, and I don't really have many revenue numbers on that. It was only a $10 million acquisition, so it's a small one. The last one. Oh, Cehaic Industries, they went bankrupt, and Worthington bought 3 facilities from them. It wasn't a complete acquisition. It was only 3 manufacturing sites. So most of this is organic growth, and with the Temple Steel one is the big driver, with obviously $377 million of $3 billion, is about like 10% in organic growth.
Thank you. Good job. First question, I have 2 questions about your valuation section. Did you consider doing a 10-year DCF to kind of flatten out some of those costs or the variability and price of steel? And also, most of your upside is from your DCF. So I was wondering how confident you are in the company versus its peers, considering there's not much upside from the pure valuation.
Yeah, thanks. Just on your first part, you say your first part.
Just the 10. Did you consider
a 10-year DCF? Yeah. I didn't really consider using a 10-year DCF just because the company has generally traded very in line with steel prices. So I think even if steel prices see very fluctuated, I think the company will fluctuate with that. And if I've modeled out historical prices to maybe be more constant in the long run, it would still just see, pretty normal with that. I think you can almost trade this company in line with steel prices. It's an 82.7% correlation just to the steel price. As for my peer groups, I know I got a couple questions on D2O. Worthington is really the only large manufacturer of steel that serves the big three in Detroit that I could find. So I think there's a big reason why they traded a premium compared to their peers. So I think that even though my relative values don't point to large upside, even point to downside in my price to earnings, I think that I'm okay with this because the company has such a long-standing history of being a huge supplier to specifically Ford, General Motors, and Fiat Chrysler.
And I'm going to piggyback off that and say two things. Even though I appreciate the DCF carries the weight, and I think appropriately so for the reasons you described, why the heck are you using a price to sales ratio on a steel company?
I decided on a price to sales ratio just because a lot of my margins decreasing, so I think that revenue growth is really important for this company continuing their performance.
Is it ever mid-teens? Because usually you see price to sales on a high growth or mid-tier type, right? You're looking for some 50% growth, 15% minimum. You ever hit any of those kind of numbers?
No, I don't have large revenue growth.
So I'd encourage you to think about alternative means when you run into this sort of situation. And then two, again, in your comps, I get that this is a very different industry, but all of your value, whatever is left of it, is being driven by a turnaround in Italy, right? Tenorus. If I strip Tenorus out, I've got a lot of downside.
I weighted Tenorus at a 10%.
I saw that. But even if I remove Tenorus, right? If I weight it 10%, I'm like, even my price, most of these things, PEs, got downside on this stuff, which is a little bit of an issue. But I appreciate that the DCF is our heaviest component. Sierra.
Yeah, so something that immediately jumps out is that they sold majority interest in Nikola Corporation, and with Nikola obviously making headlines having to pay $125 million because of fraud charges. How confident are you in the company's due diligence, and maybe you can touch on like management and making sure that something like this doesn't happen again?
Yeah, so they obviously switched over management in 2020. Worthington did. Andy Rose is their new CEO. He's been with the company since 2008. He served as CFO until becoming CEO in 2020. As far as like management style, they've shown a very consistent they're very looking for, they're passionate about growing their company and growing their revenues, which has been seen through their acquisitions. I couldn't really touch much on like the Nikola fraud stuff. I think that Worthington has made a lot of different acquisitions, joint ventures, and divestments in recent, just in the last 2 years. So there's bound to be some questionable things that maybe happen there. But I do think that this company management has a long history in the industry and has been well regarded in the industry.
One I think we touched on, but Ryan Hamilton's asking, could you give a little more color on how their ROE and ROA compare to the peers? Yeah, you want this?
Say hello to Ryan.
Hi, Ryan. So. Yeah, so their ROE is quite a bit higher than their peers in this situation. I said the DuPont analysis that I did long term, it's 46.5 ROE compared to their peer groups of 35.22%. And ROA, they're also a good bit above right now, the 25% ROA compared to their peer group of 18%.
Thank you. And then Hannah would like to know, do you know if they're looking to add to their joint ventures?
Yeah, so they've done a lot of different joint ventures. I have 9 listed in my write-up. Specifically touching on their unconsolidated ones, as they're seeing a lot of growth. Specifically, Servia Serra, who's also a steel processor, and Clark Dietrichs, who they mostly focus on steel buildings for like homes and different things like that. Like home repairs is a big thing for Clark Dietrich's. They both grew revenues earnings by over 30 million in 2021, coming out of the pandemic, and have really served positively for them. As well as that, Wave is also a home repair joint venture, and they've had consistent performance and are largely owned by Worthington.
Last word to Dr. Cross.
They have a dividend yield 1.9. What's the history of their dividend policy, Ben?
Yeah, so they've paid a dividend consistently every single quarter since they've been public. They paid about 55 million this past year, and historically they pay right around 50 million. I don't know if you want more on that.
No, that's good.
Yeah.
There you go. Thank you.
All right. All right. Last but not least, a business model that's near and dear to my heart. It's where I got my start in the business. One of the things we did in our very first company I went to work for was market making. So I'm looking to hear an updated version that's not, 100-year-old like Dr. Wall on how this business works, why we should buy it, and all the beautiful things that help you find it, as well as if there's just one question out there you feel still a little bit out in people's minds.
Yeah,
Take us
absolutely.
away. Thanks, Anwar.
Yeah, so my name is Anwar Ahmed. I'm a junior in the AIM program covering domestic financials. Kind of why and how I came across this company. There were 3 basic characteristics I was looking for in a company when I was screening for them. The first was just strong fundamentals. So I set up my screens for just like high ROA, ROE, and just an ROIC just for like strong fundamentals. Second, I was looking for a company that was using technology to set themselves apart from the competition. And that's where I came across Virtu Financial. First was just they had a really interesting suite of trading analytics software and workflow technology that seemed like it was different from anything else other players in the industry were doing. And third, and definitely the hardest to find, but Virtu checked the box here, was a company that makes sense to own right now in this type of market. Since the beginning of 2022, we've been seeing a lot of fluctuations in the market, especially because of recent geopolitical developments. And market making is just one of those unique business models that can capitalize on fluctuations in the marketplace. And since Virtu kind of makes markets for multiple assets, they have a lot of different exposure to asset classes that are going to see a lot of fluctuations, such as energy, commodities, and whatnot. So I think this stock makes a lot of sense to own, especially right now with all the with the current market conditions.
Christian.
Yeah, so I'm guessing it's going to play a little bit into what you talked about, the volatility here and how it would play into the portfolio. But can you talk me through the negative beta and why you think that is kind of maybe a hedge?
Yeah, absolutely. So the negative beta is definitely something that's pretty unique to this company and pretty unique to our portfolio. I got a lot of questions about it on D2L as well, where I discussed it. So the negative beta, so this beta is a 5-year beta. And in the last 5 years, especially 2020 and this current year, we've been seeing violent like fluctuations, especially in 2020, March 2020, when the market dropped quite a bit. The beta definitely got influenced by that, and this stock has been performing really well from the bid-ask spreads that were quite wide during those periods. So they saw heightened profitability during those times, and therefore outperformed the market as a whole. So that's kind of how the negative beta came about. And yeah, it's definitely a hedge against current market conditions. If you look at the graph on the 3rd page of my write-up, you can just see, just from the beginning of this year, how the stock price of Virtu was relative to the overall index that we follow, the Russell 2000. You can see that Virtu gained significant returns during that time, and so the negative beta is attributed to that.
Okay, awesome. Thank you.
Hey, Mr. Ahmed, one question for you. So you said in your risk that you got large debt obligations. What's your company doing to attack that?
So the large debt obligation that you see comes from an acquisition they made in 2019. I can give you some more data on
how the long-term borrowing is structured for Virtu. So they have $1.5 billion in outstanding debt, and this is like a credit facility given by a couple different banks, so it's not really like bond, it's like a outstanding note. And then they have 30 million in Japanese yen debt as well from a non-controlling subsidiary that they have in Japan. So in terms of attacking the debt, since making this acquisition, their trading or their workflow technology and technology revenue grew from 100 million to about 500 million, while the interest payments on the debt are about 80 million. So they're more than well capitalized to handle the debt.
So with the negative beta, I know this has been asked online, I think it's really worth going through this again. How you came up with the discount rate.
Yeah, absolutely. So I used an alternative method to calculate my WACC. I used a method that uses the debt to capital ratio. It's the one that we learned in class that Dr. Kraus showed us. So got to apply what we learned pretty soon. So I used a 5-year average for that. And I have some of the figures right here for how I came up with that beta or that WACC. And the good thing about this method is that it completely takes away the beta as an input. So the negative beta has no impact on my cost of equity.
Wow.
Very nice. Yeah.
Yeah, just to get bucks, can you walk me through what happened in 2021? Revenue decreased 13%, and operating income decreased 24%. What kind of happened?
Yeah, so 2020 was a year where trading revenue actually grew by 100% from the volatility from the COVID pandemic. So in 2021, when markets started to stabilize, trading revenue fell about 13%. So it's just an adjustment from just coming off of record high levels of volatility.
Okay. And why would that affect margins so much?
This company has a pretty fixed like cost structure,
Okay.
so margins fluctuate a lot with trading volatility.
That's good.
So I get the fact you're pitching us a hedge on the portfolio normally, but can you talk me through my risk? Like, what happens if the market gets so volatile it crashes? What's this stock do?
Yeah, I actually did factor that into my model. I ran a bear case, and that was sort of like a worst case scenario if trading volatility just reached a point where probably like I kind of factored in what would happen if in a market crash scenario and trading volatility falls and just overall like negative impacts on revenue. And I forecasted that my I have the numbers right here. It's a negative 74% is what I got for a return on my bear case.
Yeah.
In that type of situation.
No, super cool, right? So right, he's pitching us a play where we're hedged against ourselves, but we have to understand it only works to a limited, to a degree. Market crashes, this thing then takes on a beta of 1. It's a business where you're making money off volatility until all things are worthless, which it becomes worthless. And something I wanted to point out to the class that I appreciate Anwar taking on, especially, is this your first pitch?
Yes.
It's this whole bull bear case weighted average DCF, right? You clearly have this unusual thing that you're trying to model, and you respect the fact that there are some severe outliers that your regular DCF aren't going to be able to capture. So I appreciate you trying to fit that in. Now we got 1 and 2. Question?
Really good job. With your statistics box, is this your base case? For the
Yeah.
So in 23 and 24, you have negative revenue growth. In the best case scenario, what do you see the next couple of years panning out as? Like
Yep.
revenue-wise?
So the base case scenario takes into account that we've seen heightened volatility in the market since 2020. So I projected a pretty significant drop in revenue for 2023. I'm still projecting that that trading revenue will be positive this year just from all the geopolitical developments. For the best case scenario, I tried to stay as conservative as possible still in my bull case, just because of the uncertainty around it. I I forecasted revenue growing at like 4.5%, and then leveling off to about 2, and then in 2026 growing at 1%. So that kind of takes into account like if since 2020, if the market just entered a period of sustained volatility, it is quite possible with all the retail investors that have entered the market since then that volatility will never return to what it was pre-COVID, and that we just will see sustained volatility from now on. So I kind of take that into account.
Anwar, awesome job, especially with the bull bear base case.
Thanks.
Just going off of that, can you just kind of put a little color to your weighting behind those cases and what prompted you to give them those weights?
Yeah, absolutely. So I weighted them. I weighted my base case at 70%, and I weighted my bull case at 20%, and my bear case at 10%. And kind of the logic behind that was just kind of the probability of what I think will happen. My base case was probably the most conservative, I would say, in my estimates, and a little bit in line of what would happen past 2022, because it is quite uncertain. So I forecasted, so I weighted that more just because the forecasts were a little more conservative. I did 20% for the bear case, or the bull case, sorry, just because of the fact that it seems probable now, especially with recent developments, that we're gonna see heightened volatility and ongoing volatility, especially with what's going on in Russia and Ukraine. There's no end that we can kind of forecast, so I think that that's a little bit more probable. And my 10% weighting for bear case, that's highly, highly improbable. I really doubt that, from what I've been researching, that trading volatility will ever fall below 2020 levels or 2019 levels, just because that would mean that millions of retail investors exited the market and there's no trace of them, which is highly unlikely, but I still modeled it. So that's why I give it the least amount of weight.
Your crops.
This is a real kind of wild card risk, but I think it's real. What about DeFi, decentralized finance, and more trading potentially going off of exchanges and into, a decentralized blockchain world?
Yeah, absolutely. So actually, this firm actually does have market making for off exchange trades, even for crypto and other like asset classes that are becoming decentralized and don't necessarily need to rely on a centralized exchange. They do have dark pool liquidity solutions, so they are in the space. So in the case that happens, they will be exposed to it. So it's not that they're not players in that space.
Okay.
And also one thing interesting too is that in recent years, it looks like retail investors are getting access to more asset classes. Right now, most retail investors are only trading equities and options in crypto, but it looks like there's a lot more. There's a lot of fintechs working right now to expose retail investors to new asset classes like commodities and currencies. So
Awesome. Use Rishi's phrase.
Is that monster wearing off on you or what? I see a little mellow right now.
I'm good. Inside story.
Yeah, is it?
Is it though?
Okay, Anwar, thank you.
All right.
Please shut up.
Christian,
Yeah,
close us out.
yeah. So I know that this is kind of a unique public company. Can you walk us through how you came up with the comp sheet?
Oh yeah, absolutely. So interesting. It's interesting to understand how the market making industry works. There are very few public companies in the space. Their largest competitor is Citadel, and Citadel is a private company, so I couldn't really use them as a comp. The closest comps I could find were exchanges. Exchanges are not perfect comps because they're kind of where market makers go to create markets. And they have a NASDAQ, I know, has like a market making division themselves. They try to make markets. So those are about the closest I could get. They're a lot larger than Virtu is. But they're about the closest, and it looked like the sell side analysts and other analysts covering the stock were using the same peers as well. So that's why I thought it'd be appropriate to use them. I weighted them only 5% in my model, just because my DCFs were so comprehensive of all the possible scenarios. So I didn't want too much value being driven from the comps.
Okay, fair, thank you.
And again, exchanges tend to make money if volume increases in volatility, which means it's at least somewhat of a proxy.
Right, the revenue stream should be correlated with what Virtu does as well.
Anything else?
Thank you, Anwar.
Without further ado then, enjoy your spring break.
Have a good spring break.